Hi, welcome everyone to Views from the Bridge. I'm John Fisher, President of Bridgeport Asset Management. Bridgeport manages both publicly traded and private asset portfolios for a wide range of investors and their advisors. I want to welcome today Pierre-Antoine de Selancy, who is co-founder and managing partner of 17Capital. Bridgeport is an investor in two of 17Capital strategies through our Bridgeport Alternative Income Fund and Bridgeport Private Equity Opportunities Fund, both of which provide investors with diversified global institutional caliber exposure to private credit and private equity, respectively. Our alternative income and private equity funds are each currently invested in over 20 individual strategies in partnership with top-tier global private asset managers like 17Capital, providing exposure to thousands of individual assets. The purpose of today's chat is to spotlight 17Capital's investment strategies within Bridgeport's funds and hopefully help everyone gain a better understanding of what NAV finance and structured private equity are all about. Pierre-Antoine, welcome again, and thanks for speaking with us today.
Good morning. Nice to see you.
Thanks. Maybe take an example just for our audience, because it's sometimes your strategy, it's really unique, and I think it offers phenomenal risk-adjusted rates of return, but it sometimes can be a little complicated to understand what you're doing. So, let's just take an example, and I know you've got a lot of different types of transactions, but it sounds like the initial type of investment that you were making was something about, let's say, you're dealing with a large institutional investor. It's a pension fund. It's got billions of dollars of assets. It's got a chunk of its portfolio, 10, 15, 20% of its multi-billion dollar portfolio invested into various private equity funds. And it's looking to potentially realize some capital, I guess, out of its private equity fund portfolio. It may have interest in, just to throw out some blue chip names of private equity funds, not to suggest that you necessarily done business with these groups, but just because people know these groups and it makes it real. It could be KKR, or it could be Apex, Europe, or it could be Carlyle.
We work with both.
Yeah, or Apollo. And so we are a huge pension fund, and we have interests in 6 or 7 large private equity funds that each own a bunch of different portfolio companies. And we're looking to maybe reallocate $50 or $100 million out of our private equity portfolio because our investment committee says we want you to put it back into public equity. So how do you come into play? How does 17Capital come into play with a pension fund or other institutional investor that may have that issue of we need to reallocate capital out of our private equity fund allocations and into some other area of our portfolio? And why would they come to you versus doing some other type of transaction, maybe with a secondary fund that'll just purchase their interests?
Sure. This is it couldn't be more topical today. When we started back in 2008, our aim was to provide an alternative to the secondary market to all these institutional investors. And each time an investor had kind of an overexposure to the private equity industry, they had to sell.
Right.
And really selling at the bottom of the market is probably the worst decision, especially if you're in a long-term investment strategy business. But a lot of people sold in 2009, 2010 at the bottom, and that's probably one of the
sold
worst
their
decisions.
Fund interest. Just for our audience, you're basically saying I've got a $50 million interest in KKR's fund. I may not necessarily really want to sell, but I found a third-party buyer, maybe another institution that's willing to buy my existing fund interest, probably at a discount to what I think it's worth.
Yeah, so that's what we call, industry jargon, the denominator effect. Basically, a pension plan will have, an equity exposure of say 100 million, billion, whatever, over 100, including 20 within the private assets, industry,
Right.
and 18 in liquid. And if the liquid assets lose 20%, suddenly, your what was 20 on 100 is 20 on
Yeah.
84.
You're over
And so
allocated out of private
you're at
equity.
25% exposure.
Right.
And you have the board of trustees or the investment committee. So, well, we decided to have 20% in private equity, not 25.
Right.
And of course, the valuations within the private equity industry are less volatile, and they're meant to be less volatile. That's why institutional investors invest in private equity or private credit, because volatility is not there, or far less.
Right.
So suddenly you find yourself with an over allocation to private assets, and that's when you have to sell. The alternative, which we can do for these, is help them recap that, or we can fund the next capital call. So when the funds continue to call capital for new acquisition, we come in and we fund that. So we sort of last in and first out on their portfolio. And we help them not increase their exposure. So that's the way. So they don't have to sell.
Right. Right.
Otherwise, they would have to sell. Or if the portfolio is worth 20, we give them 5, and then we share the distribution. The exposure comes down to 15.
Right.
And 15 on 84 is within the boundaries they have to set themselves initially. So that's and we're seeing a lot of that in today's market. And it was a big market from 2008 until 2012. That market probably reduced to between 10 and 20% of the overall market we're addressing, and now it's coming back quite strongly, actually.
Right.
So working with institutions, but since 2012 until 2021, institutions were more long cash and didn't have an exposure issue. But
Right.
we're working a lot with the private equity managers to help them improve the performance of their of their funds. And I can give an example.
Yeah. So I imagine that the recent meltdown in the stock market has created a lot of opportunity for 17 Capital, and that a lot of institutional investors have seen the value of their public equity and their liquid fixed income portfolios go down in value, while their private equity portfolios have sort of, held value better, such that they need to realize money out of their private equity portfolios because they're now just over allocated to private
Yeah,
equity by virtue of the fact everything else has gone down. And 17 Capital's sort of providing, one option for them to do that
yeah,
while retaining ownership of their private
exactly,
equity. So, I
exactly.
mean,
And what we allow them to do is find liquidity and manage the exposure without losing the upside. Of course, if they
right,
sell, they might sell at a discount, so that's creating a loss.
right,
Plus, they're losing the potential upside. When
right,
we do a deal with them, we can provide them with capital. We can lend them the money, or we can do a preferred equity structure.
right.
Various types of structure depending on the legal and the tax environment of the operator. But that's what we offer. And
So yeah, so I mean, in effect, for our audience, you are, you know, either sort of lending or taking a preferred equity position, in some cases against an institutional investor's a basket of their private equity fund interest, one or more private equity fund interests. You are, in effect, lending money against that at a loan to value. I mean, to use a more simple example for our audience, in a very simple way, it's kind of like you're lending money against a house. In this case, the house is really a basket of private equity fund interests, which are backed up by individual interests in individual private companies. But it's like you're lending money against a house at a loan to value. You're making sure, I guess, that there's a cushion behind you, quote, as a lender, quote, kind of lender
yeah,
again.
yeah, sure. So that's exactly what we do. Maybe to give another example, so we can
Sure.
work with institutional investors on a highly diversified portfolio of investment in funds, but we also work
Yeah.
with funds. And I give an example. We work with a European fund which owns 14 companies. The total value is 2.5 billion euros.
Okay.
That's a 2017 fund.
Right.
95% of the capital has been called and
Okay.
invested in these 14 companies.
Okay.
And last year, actually, well, last year and then earlier this year, the manager identified investment opportunities in these companies. In one case, one company needed equity to make an acquisition. And in another case, it was a co-investor in another portfolio company that needed to sell. It was
Right.
actually a fund, another private equity fund, which was in year 11 and 12 and needed to realize their position. And so we lent 300 million to that fund with value of 2.5 billion. And
Right.
the transaction is we give them the money. It's going to be used to invest in the portfolio companies, in two of them. And whenever any of these 14 companies is sold, we get repaid.
Right.
But in this case, so we're at a very low loan to value, 300 million on a portfolio of
Like
2.5
12
billion.
or 13% loan to value. So you've
Exactly.
got a portfolio of assets worth close to $2.5 billion.
Yes.
You said you lent about
Euros, but
300 million euro against 2.5 billion in assets, which is spread across 13 or 14 companies.
14 companies, yeah.
And then
And diversified in industries. You have one company which is a fund administrator. You have another company which does scuba diving equipment. You have another company which does healthcare, critical software for hospitals in Europe. So it's extremely diversified.
yeah,
And that's an important part of our
yeah,
work.
that's
We need to
key.
understand
Yeah,
diversification. We look at the level of debt on each of these portfolio companies. The fund started investing in 2017, so we benefit from a number of years of ownership of these companies when we make the loan. And we know, typically when a private equity fund makes an acquisition, they have the first 12 months is when the risk is at its highest. That's when the manager will understand whether the due diligence was right or not,
right.
whether they missed the point, whether the management was actually much weaker than they pretended to be, whether they were hiding some numbers, etc. So once you're after that first 12 months period, you're in a much lower risk environment. You know the company, and and the average age of companies in the portfolio when we enter is typically between 3 and 4. And so we benefit from that
Yeah,
hindsight. When we lend money to a fund which is in year 5 or in year 6, we can see how the portfolio developed.
right. Interesting. And so maybe talk a little bit about using that example where you quote lent 300 million against the $2.5 billion worth of
It's not quote.
private
It is a loan. It is a true loan. It's a 5-year loan with
yeah.
security on the
Okay,
asset.
so this is your credit strategy. Yeah,
That's the credit strategy.
yeah. So that's the credit.
Yeah,
So
because we're below 15% loan to value, because there's 14 companies, we price it
yeah,
at credit. But we would do the same if it was 4 companies and they needed 50%. Then it would be
right.
preferred equity.
Okay.
We adapt the price to the level of risk,
Level.
and then we have these two families of fund. But really, we're one organization providing financing to the investors.
Okay. So in that case, maybe, which is your pure kind of lending strategy, maybe just talk a bit about how you get repaid on the $300 million, how that cash flow waterfall works with the underlying 14 companies as kind of security there.
Sure. Maybe just me to set the scene for for the people who are going to watch this. We started in 2008, and we're now investing of fund number 5 on the
Right.
private equity side, which is $2.9 billion. We're investing our first credit fund, which is 2.6 billion euros. We've done 89 investments.
Wow.
And 44 exits.
Right.
So in terms of exits, the vast majority of them happen when, out of these, if I come back to the example of this fund with 14 companies, they sell them, we are repaid on each exit. And then when they come closer to having 8 or 9 companies, we take 100% of all the cash.
Okay.
We don't want to be in a portfolio with less than 6 companies on our credit strategies.
Right.
So we say, okay, if you get to 8 or 9 companies, we're going to take everything so we can be out faster.
Right.
We are repaid when they sell companies. And out of these 44 exits we had, we've got 15% IRR on average across these 44 exits. I think in probably 4 or 5 cases, we had to turn around to the manager and tell them, now we need to sit down. We're getting to the end of our fund. Can we agree on an exit and you buy us out?
Right.
And we've never lost money ever on
Right.
anything.
Yeah, on a single deal, you've not lost money since you started.
Never.
Yeah, which is great.
Never.
Yeah. That's sort of
And
a lot. Through a lot of ups and downs and different market conditions, different macroeconomic conditions that have occurred over the last almost 15 years here. Yeah.
I haven't said everything always went according to plan. I didn't say that.
Yeah.
Things happen and life happens and an investment can develop and go in a different direction. And then sometimes we were repaid far too quickly. Like one of our very first investment, we got capital back within a year, and we didn't like it. We want our investors' money to be at work for more than a year. So then we improved, and we said, okay, well, we're happy to invest, but if you repay us early, you need to pay us at least 1.3, 1.4, 1.5 times the money. So we inserted conditions to protect our investors' capital. But the vast majority, at 90% of our exits, happen through forecast liquidity, sometimes faster, sometimes later, but by the sale of portfolio companies that generated liquidity and that repaid us.
Right.
We also put mechanism in the structure. We can be at a certain price for the first 3 or 4 years, then we increase our price.
Right.
That puts more pressure on the manager to exit us.
So like in some cases, as time goes on, you're looking for higher rates of return, which would incentivize the borrower to pay you back quicker.
Or it makes our investment more liquid.
Right.
If they can repay us, if suddenly we go from charging 13% to charging 17%, either the manager accelerates the sale of one asset and repays us, but if they don't want to do that and we need to get out, then we can turn around and find one of our investors, typically who will take over the investment, will have appetite for it. So that's one of the tools we had to improve liquidity for our investors.
Interesting. Okay. As I indicated at the start, Bridgeport is invested in 2 of your strategies. One of them is your 5th fund, as you said, which is your, I think you call it your sort of preferred private equity strategy. And then you recently closed your first fund that's more of a pure lending strategy. Maybe you could just contrast the 2 types of strategies as to what does your preferred equity structure look like? Maybe where does it fit in? And where does your pure lending strategy kind of fit in? Like, sort of what are the differences between the 2 in terms of risk, rate of return, and how they're structured?
Very easy. On the preferred equity, we're on average today at 42% loan to value.
Okay.
And
on average, kind of 42% loan to value is what you do. Okay.
Yeah.
Okay.
On the credit, it's 16%
loan to value. Okay. Much lower, much less risk
lower
on the credit side.
And credit, at least 7 companies.
Okay.
And preferred equity, 4 companies, so slightly more concentration.
4. Okay.
But the key difference is we have security in the credit and a maturity. If we have not been repaid after 5 years, typically, we can take the portfolio, take control, sell it to get our money back, which we cannot do it on the preferred equity side.
On the preferred side, it's just a waterfall of kind of cash flow that comes back. You don't have any say when it comes back, but on the preferred side, do you get all of the cash flow from any distributions out of the portfolio because it's such a small portfolio? Like, does all the cash flow go to pay you back first?
Typically we would have a higher seniority. We'd have more often 100% seniority on the cash flows, and while on the credit it can be sometimes only 40 or 50% and not 100. But it's always a combination of, we want our investors' money to be at work up to a point where the risk is too high, then we need to get out.
Then you need to get it back. Yeah.
So and that's the fine line. You want the money to work, and make babies really, but
Yeah, sure.
but then not to a point where it becomes too dangerous for the price we're charging. Then we accelerate
Yeah.
the distribution
Okay.
and we get all the money back and we
Great.
get out.
And then broadly speaking, under each of those two strategies, how do you structure the rate of return that you're looking for? And sort of broadly, what types of rates of return are you currently looking for under each of the two strategies?
On the credit, we're today looking at anywhere between 7 and 900 above SOFR.
So that'll be SOFR's where now? Sorry, maybe just for our audience.
Not far from 4%.
Okay,
Between
so you're looking
2.5%.
for all in currently, sorry, like 11 to
All in, all in. There's upfront fees, etc. So all in today, we're between 10 and 12%.
10 and 12% on the credit strategy is what you're
Yes.
looking for all in. And are the returns, are they variable or is it fixed at the time that you do the deal?
No, it's a margin of a rate, of a base rate.
Okay, so it's actually variable. So in the future, as interest rates increase, if interest rates continue to increase, I should say, hopefully they don't, but they may. Theoretically, you might be actually collecting higher interest income going forward in a rising rate environment on the credit strategy. Okay.
Yes, correct.
Great.
And on the preferred equity, you can think as being roughly 500 basis points higher, so between around 16%, 16 to 18% today.
Okay, 16 to 18% all in.
Yeah, and that's sometimes it's a combination of capitalizing interest rates and some equity upside, some participation in the performance of the portfolio.
Right.
We have it sometimes, not always. It depends on our perception of the portfolio upside. It also depends on the size of the portfolio. If it's a very diversified portfolio, very deep, we don't want to be in there for the next 10 years, so we're not going to get equity. We don't want equity. There's a number of criteria which will dictate whether we get equity or not. But overall, today, 16 to 18%, 15 to 20% is not a bad range.
Yeah. So I mean that sounds sort of very attractive if you put it into context that depending whether it's the credit or the preferred equity strategy, you're looking to price it, at like 11 to 18%. But we need to keep in mind that you have this equity cushion underneath you where you're probably only lending or doing a preferred equity piece at a loan to value of somewhere between 10 to 40 or 50% maybe. So that, am I right in thinking that to lose money, the portfolio, if you're doing at the high end, you're doing a 50% LTV, the portfolio ultimately to lose your principal needs to be worth less than half of what you thought it was at the time that you're underwriting? Right.
Correct.
There's a fair amount of cushion.
It needs to be sold for less than half.
Yeah, sold. Right. And then on the credit side, do you have covenants and things if the sort of asset value that is estimated for the portfolio is going down, does it trigger covenants?
Yes, it triggers. So we have two types of covenants. We have covenants that change the waterfall and accelerate the cash for us. And then there are covenants that are really a default, in which case we take control. Yes, we absolutely use covenants.
Give us a snapshot of your assets under management at 17Capital. I think you've got a couple offices, where they are, how many staff, just like a little bit of background.
Sure. I'm happy to do that. We probably should have started with that, actually.
Yeah, probably. It just kind of dawned on me now. Yeah.
We are so we're 70 people in the business now. And some half of us in the investment, the other half in investor relation, and then the rest in infrastructure, so finance team, HR, marketing, and then we manage $11 billion in total now, and we are completing the deployment of our fund 5 on the preferred equity, and we just launched our fund 6, and which is going to be open for investors in 2023.
Great.
and we are completing deployment of our first credit fund, which we closed earlier this year at 2.6 billion. The target was 1.5, so we went above that. We have an office in London. We have an office in New York. We have a board member in Toronto.
Yes,
And
that's right. I think I've spoken with him before. Yeah.
Dimoisiak is as I mean is we're in business partly thanks to him. He used to run Hoop Pride actually a long time ago,
Right.
and
Hospitals Ontario Pension Plan here. Yes, a big group.
yeah,
Yeah,
and
managing.
maybe I should also mention another important part of our recent evolution. We as we were growing, we noticed the North American market is substantially deeper than the European market, and we've
Yes.
deployed $4.5 billion this year, half in Europe, half in North America, half in credit, half in preferred equity. But we thought the opportunity is deeper in the US, and we should try to find an industrial partner to help us speak to more private equity managers in the US. We ran a process and we ended up selling half of 17Capital to a group called Oaktree,
Yes.
which I'm sure you've heard of, which is a 160 billion private equity manager, which has a shareholder called Brookfield.
Yes, Brookfield
So,
Asset Management, well known here in Canada. So, sort of indirectly, you're 50% owned by Brookfield Asset Management,
yeah,
Oak Tree, right?
yeah. So we continue to operate completely separately, completely autonomous. Nothing has changed in the governance, in the way we recruit, in the way we raise a fund, in the way we invest. The investment committee is completely unchanged. There's one observer, but she doesn't vote. So we can source transaction, price, execute, monitor the portfolio, realize in a completely unchanged way from what we agreed with our investors when they gave us when they trusted us with their commitments. Um, and yeah, so it's been a significant event. Definitely put us even more on the map. I think it confirms that we operate in a market that is growing fast, and we think it's $100 billion market today, but with a view to be probably 300 billion in the next 5 to 7 years. So there's a lot of growth for us, and I think the partnership with Oaktree confirms that, and Brookfield confirms that. And about our investors, almost half of money is pension.
Pension fund money. Okay.
Yeah, 20%, a little bit over 20% is insurance companies. Around 20% family offices. And we have the rest are sovereign investors, endowments, foundation.
Yeah.
We have quite a few sovereign investors in Europe and in Asia as well. And maybe geographically, almost 40% of our money comes from Canada.
Oh wow, 40%. Okay. Yeah, and like obviously, Hoop. I think I'm not speaking out of school. Is still a fairly significant investor.
Yes, they're investing in all our funds, and they've been amazing. They are amazing partners. But there's a number of other groups we work with also in Canada, going from Halifax to Victoria, both ends
Great.
of the
Okay.
country.
That's great.
And I'm actually there. We actually we used to do an investor meeting in Toronto in the spring every year because we have so much investors there. We stopped it during COVID, but we're going to do it again from now onwards.
Sure.
So,
Pierre-Antoine, I want to thank you very much for spending the time with us today. And I want to really congratulate you on what you and all of your colleagues at 17Capital have built. I mean, it's a phenomenal story. It's a really unique strategy that you have that, fills a void in the marketplace. Here at Bridgeport, we really, really appreciate the like partnership that we have with your firm, and
so do we.
So I want to thank you very much.